What's going on, guys? Welcome back to the channel. Today we are talking about Etsy. Now, on Wednesday they reported their earnings. They did well, had higher EPS than expected, had higher revenues than expected. They beat earnings, okay? Here's the thing, folks. This company rose, what was it, like 15% in one day? Absolutely wild. And went from like $87 a share to $100 a share. Now, here's the thing, folks, that gets me a little bit concerned, and what I'm trying to teach here on this channel. Yes, this company beat earnings. Yes, I'm very happy for them. But when you see jumps like this is where I get not cautious, but I get concerned, because look at this. We thought about the company was $300 a share. We thought the company was great at $200 a share, right? And then boom, it comes down like this, right? Look at this spread here. And this is what I like to look at, folks. We had a low of $67 a share and a high of $300 a share. Where is this value coming from? And why are people suddenly all up in arms about this? Obviously, it's good. It's good to see companies obviously make improvements. To affect the company's share price by 14%, you have to kind of shake your head at it a little bit and say, is this overreaction? And I think it is. Now, I've made a couple of videos where I see companies' stock prices drop, and I get so excited because they don't know what they're obviously doing. They're selling off these great businesses. Now, I don't know if Etsy is a phenomenal business. We're going to dive deep into those numbers and see what that's all about. But when I see a company shoot up in price, I get a little bit concerned. So I'm loading up here the cash flow statement of Etsy. Now, on an annual basis, what am I looking for here is some discrepancies, like anything that's kind of just stands out to me. So right off the bat, negative 4,500,000, 2.5 million, 8, negative, positive, 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 and a little bit of a dip here in free cash flow, but it's been going up nonetheless. Okay, that's good. Net income, a little bit rocky. We get positive in 2017 and positive in 2021. Okay, cool. Now we go to revenue, annual basis, same thing. Now there's been a general progression of this company, which is great. High profit ratio, that's actually not bad. 73, 7, okay. It's been pretty consistent. Okay, so it's been a pretty consistent business over the last 10 years in terms of how it's been rising. And on the board here, we're ranking this company a 7 out of 10. I mean, I could have just looked at this and probably would have taken less time, because we are seeing an improvement of revenue growth, obviously, over the last 5 years. The return on invested capital is up to 10.92%, which is a high number. This is what we want to see. Their 5-year free cash flow is crazy high compared to where they were 5 years ago. Net income is growing, and return on equity is sitting above that 15% mark, as well as their EPS is also up. So a lot of positives for Etsy. The only thing that they are doing wrong, folks, and the things that are raising red flags are, you see these zeros here? Boom. Look at this. They're trading at a very high PE ratio, so that's at 56.18. We want to find companies underneath 22.5. Currently, apparently it's at negative 19.68. That'll probably get updated in a day or two, but probably not in a day or two, by tomorrow actually. But 56.18 is a very high premium for this company, as well as the debt to equity is sitting at 379%. For the record, folks, we want to find companies that have a debt to equity ratio beneath 50%. Why is that important? Well, that just indicates to us that they are leveraging their capital through equity and not taking on debt. So with 379%, that just indicates to us that they have a lot of debt, how they're leveraging the capital. Not something you want to see as we're on the cusp of a recession. A lot of the episodes I've been putting out, I call them episodes, but a lot of videos I've been putting out are about these companies that can weather storms of these upcoming recessions. Now, I've talked about Coca-Cola, I've talked about Google and stuff like that, because these companies carry low debt. Ideally, you want to try to find companies that are carrying low amounts of debt, because as revenue will eventually be, let's say, stricken in some aspects as we approach recession. Because here's the thing, folks, consumer staples are always going to do well in recessions. Gas, food, stuff like that, those are important. Etsy is a very niche market. Etsy is a company that pertains to people that sell craft goods. So if you want to get, Alexa, come on, man. I'm trying to make a video here.
Sorry, I don't know that.
I know you don't. Stop, Alexa. Stop. Alexa, stop. Just stop. Please. Here's the thing with Etsy, guys. So Etsy is a very niche marketed business. They sell craft goods. So you can go on this site if you haven't been on there. And there's a lot of people that do arts and crafts, very talented individuals in the crafts that they do. And it acts as a hub. My point is this. It is not a consumer staple. Coca-Cola, ExxonMobil, those are good companies in terms of recession because people need gas to get to work, heat their homes, stuff like that. Etsy isn't a company like that. Etsy is a company that you have some spare change and you want to get something nice for yourself. That's the business you go to. As the recession and inflation gets higher and higher, people are going to reduce their spending, and most likely what you're going to see is a decrease in this revenue of this business. So the long-winded point that I'm trying to make here is that when you see a stock price go up incredibly high for no reason, like 14% in a day, get ready because that is going to probably come right back down once they report that their earnings have been decreased. It's only common sense. What goes up must come down if it's unjustified. And when you see super spiky charts like this, like what is going on? That is something that's going to probably get hit extremely hard. Now, I'm not saying it might happen tomorrow, but it's just something to keep in the back of your head that it might happen in the near future. I'm going to do an intrinsic value of this company. So I'm going to use the price analysis section of my software here, and I'll do 10-year analysis. I'm going to put in some numbers that reflect what we've seen in the historic averages of Etsy, and we'll talk about what I did and try to price out what this company is worth today. $100 a share could be very well a premium. Could be undervalued. I highly doubt it, but we'll see. So stand by while I fill out these lovely boxes. And folks, if you're enjoying the video so far, hit that like button and the subscribe button. The software I'm using in front of me, 7-day free trial. Follow the link in the description box below. That's leodeleo.com. It's a stock analysis software, so check it out. Cancel anytime if you like it. There's a founder coupon that you can use. Just use founder when you go to checkout, and with that you'll get 20% off your subscription for life. So don't want to miss that out on that. Now, here's the most intricate part of my software, and this is the price analysis section. My God, that is a tongue twister. And basically what this software does is finds the intrinsic value of the company. Now, if you're new to the channel, I like to try to stay as conservative as possible. So I've done conservative oh God, there's a lot of green numbers there. Let's take a look at that in a second. But what I like to do is do conservative revenue growth numbers for my conservative, moderate, and aggressive categories, sticking to what I've shown on the board here. So 34, 47, and 48, I'm going to go 20% revenue growth over the next 10 years. $12.66 billion. Wow, it's actually a small company. I got to say, $12.66 billion company. You know what? That's actually pretty reasonable. I think it would definitely hit those numbers. Now, I could be wrong. I want to maybe potentially decrease this further, but we'll see that in a second. But I gave it a haircut compared to what the numbers are currently on the board here. Profit margin, I kept it roughly the same, close to our 5-year numbers. See, 16.90. So I did 14, 14.5, and 15. Same thing with the free cash flow margin, sticking within that 10-year number instead. And these numbers here, folks, you can put whatever numbers you want in these boxes, but this is a good ballpark because if it's historically done that, we could potentially use these numbers plus a little bit of a discount to give ourselves an additional margin of safety, and that's what we're trying to do here, folks. Now, price to free cash flow, same thing, and PE ratio, moderate numbers. We want to find companies with a price to free cash flow underneath 20 and a PE ratio underneath 22.5. Or 20 is also good as well. So underneath 20, the 20-20 rule. Desired return 13%. Put that in. Current price is $100 per share. Average calculation comes out to be $226.46. Not the number I was anticipating. Given what I've currently seen. So, what does that mean, folks? At the current moment, Etsy is an undervalued company if you believe these numbers. Now, that means if you pay $226 per share today, you can assume a 13% return over the next 10 years. Now, on the conservative average, this is the lowest revenue growth numbers. That's $144. Currently at $100 right now. This is the category I'm looking for the most. If I see green across the board here, I like seeing that. Now, what I want to do here, folks, is just to try to find the lowest revenue growth numbers possible, because that would give us the most margin of safety. Interesting. So with that being said, total value right here in June, total overvalue back in November. Wow, that's it's crazy. So look at that. Average calculation 94.53. So you know what? Before those earnings actually came out, it was actually in that pretty much. It was actually in this territory right here. It's just that you people had to. Sorry. You people had to drive up the price so much in one day. But man, look at that. It was at $87 in the beginning of the day, and then you guys had to just shoot it up, right? Oh god. Okay. Well, it's fine. I'll eventually wait, because eventually what's going to happen, I'm hoping, is that people realize that they have weekends and want to sell off. But right now, based off these numerics, pretty much at fair value, I got to say. So, you know what? Not what I was expecting. I was expecting the thing to be completely overvalued. But you know what? Etsy really turned me around. The only thing was that is a concern to me, though, is this debt to equity ratio, and I don't like the dilution. So if I can live with those two, I guess, discrepancies, this may be a buy for me. However, there's other companies in my watch list that I think are potentially better than Etsy, and one being Amazon. That's probably the largest e-commerce platform. But yeah, the high debt levels really are the make me cringe a little bit, make me squirmish. So that's just my opinion. But if you are looking at this company, it's pretty much at this fair value with really conservative growth numbers, if you really think about it. But yeah, folks, if you enjoyed this video, hit the like button, subscribe button, check out the software, it's down below. Final thoughts on Etsy. These high debt levels may be an issue as we approach a recession, something to keep an eye on. That's why it's important to take a look at everything, and this software does all those things. So from a numerics perspective, it's worth it, but this may hinder the business going forward, and you may get trapped. So that's something to keep in mind. Anyways, folks, that's the video. Thank you so much for watching. I'll see you in the next one.